following is a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure, your host. Guy Allard is on vacation. So since he's being a slacker this week, I'll do this old school by myself. Want to thank you. For those of you new to the show, we've been on the air, commercials and radio shows for decades here in Dallas. We're one of the old guard, I guess. I'll call it experienced, but other people might say those are the old guys on the radio. We have a philosophy at McClure Capital. We've always had this philosophy, no matter what the stock market has done. No matter what North Korea does, this philosophy is based on mathematics. Our philosophy has been and always will be that if you have a portfolio, if you're going to retire in the next, say, 10 years or already retired, either way, and you have a certain amount of expenses, let's say those expenses are $10,000 a month, we believe you should have a guaranteed income stream of $10,000 a month, some way, somehow. You can use many things to secure this income stream. You can use CDs. You can use bonds. You can use annuities. The last several years, probably 10, 15 years, since interest rates are so low, annuities were the most efficient way because you can get more income per dollar on those. But it doesn't matter how you secure it as long as you secure it. The problem comes in, let me go with this. So you need an income stream to pay at least your hard expenses. You can have discretionary expenses covered by other things like the stock market and things like that. We've talked about over the years how having all of your money in the stock market and having to spend down a portion of your stock market proceeds to pay their expenses is fraught with a lot of risk. There is more risk in this than you could imagine. I'll give you one quick example. Let's say you've got $1 million. The market's gone down 50% twice in this century, since 2000, and it happens again. Well, let's say you're planning on taking 5% income out of your $1 million to live on. Made sense, 5% for the last 20 years if you don't lose any money, of course. Then you might get some gains, so maybe it lasts longer. But the fact is, one down year, one significant down year, it could be 20, 30% as well, messes everything up. But let's say this 50% happens again. You have $1 million. You lose 50%, so now your account value is worth $500,000. And you take out the 50. So you have $450 after one down year. We talked about this before. If you have 3 20% up years in a row after that, remember, you still got to take out your 50 to pay the bills every year. Bills aren't going to stop. And get a 20% gain on the balance. And that's pretty strong because rebounds usually are more, they go up faster than something goes down typically. So the rebound usually can be pretty good. But even with 3 20% down years, you're only left with maybe 60-something% of your principal. And so having less than 3 20% down years is more likely. That's why I call it the death spiral. The stock market was never and has never been and will never be designed to pay your bills, because selling into or having to sell some of your stocks or bonds to pay expenses it creates this death spiral you can't get out of. I ran an analysis on the market the last 17 years, this century, since 2000. Market's made 4.06% per year. It's averaged 6.16. But averages don't mean anything because average would be based on a static principle, which obviously the stock market doesn't have static principle. So if you took out the 4% the last 17 years, you only have about 600,000 on your million, and we haven't had a down year in almost 9 years. So one more down year hits it, and it's over. And so avoiding those kind of traps is the key And the whole philosophy behind us saying that you got to have a guaranteed income stream. We talk about annuities a lot just because they give you more income per dollar. If I've got $1 million, I can get 50 to 100,000 a year out of an annuity when a CD would pay you 10,000 a year, when a 10-year bond would pay you 30,000 a year. And so that's the reason that we use them a lot, but you don't have to. Remember that it's not imperative to use an annuity. It just takes less money to get more income. But if you do it that way and use the stock portion for any discretionary expenses or reserves or anything like that, you don't have to sell when the market goes down, so you can still be there when the thing rebounds, which I understand it doesn't always have to, but it always has. So I love the stock market. We've been managing people's money in the stock market for decades. We use Fidelity because I've always liked Fidelity. They're not some, they're a private owned company, and they're not some conglomerate that gets in trouble all the time like some of the other big ones, some of the banks and things like that. So you secure your income stream, and then you use the stock market is a great place to fight future inflation and have discretionary expenses and all that kind of stuff. Future inflation is something people always underestimate. Even a 2 or 3% inflation rate will make your expenses go up significantly during retirement. And just because you have $5,000 a month in bills now, $10,000 a month, it is virtually impossible to have that amount of bills in 20 years. If you just think about your personal experience, going to the grocery store. I remember when I was raising a young family. Now I have more kids, being older, but when I was raising a young family, I used to allocate about $50 to $100 a week in groceries. And that was for, 3 people. And so that was pretty good. That got us we never starved. We always had plenty of food. I remember back in the day I had, when I was in the military, trying to support a family on $300 or $400 a month. That was a joy. But so allocate. Now, I want you to ask yourselves out there, all of the listeners, can you allocate $50 to $100 a month a week on groceries now? Oh my gosh. I'd spend a couple thousand a month at Costco, and we still go to Kroger and everything else. And so those kind of things are not going to change. It's going to continue to go up. Look at your water bill, your electric bill. All of those have continued to go up. And if you have the delusion that somehow in the future they're going to charge less for electricity, I got an oil well to sell you in somewhere, right? They're not going to go down. Expenses will go up. My dad used to buy brand new Lincolns and Cadillacs for $6,000 or $7,000. Obviously they're more now. But little things like that. Obviously, everything doesn't go up with inflation. Otherwise, a loaf of bread or a dozen eggs would cost you about $200 right now, and they do not. Oh, heck, they're pretty close to the same price, when I was a kid. And so we talk about, and that's what, when you come to us at our company here, since 1982, we have been advising people on how to secure the income component to make sure your bills are paid no matter what happens to the market. That's what a plan is supposed to be. A retirement plan should not be, if we've averaged 8% a year on our managed account, and if you just get 6, you're fine. That is not a plan. That is a hope. You hope the market continues to make. Because think about what you've done. You've just planned your entire retirement, and the market has to make 6 to 8% a year. When we know it's made 4.06 with dividends the last 17 years. And by the way, 90% of people do not beat the S&P 500. 90% of advisors do not beat the S&P 500. And so their average is about 2%. And this includes all the people out there you hear that hate annuities and everything else. Their returns are very similar. They'll give you an average, and average means nothing. You can take the actual returns, add them together, start with a static number, and you'll find out what they actually made. And it's amazing because people think it's human nature. We think short term. It's hard to remember that the market crashed 50%, 9 years ago. It's hard to remember. Then before that, 8 years before that, it did the same thing. Because what we're thinking now, my stock portfolio has done pretty good since Trump got on up for a long time. And that's what you think. But you have to put it in a broader perspective. You have to say, all right, I know the market has gone up well the last few years, and I've been I've benefited from it. I can't talk today, and I will hopefully continue to benefit from it. But you secure this income stream, and you do it sooner than later. It costs you less money. So let's say I want to retire in 5 years. Instead of waiting for the retirement date, that's going to cost you X amount of dollars. You can get it for 50% the cost or less by doing it now and deferring the income until that 5 years is up. What we're going to talk about today is, after the break, what do you do with that stock market piece? Okay? So stay with us, folks. Remember, if you have any financial questions or you'd like to take advantage of any of our complimentary services like a retirement analyzer, Social Security optimizer, any of our family love letter, don't hesitate to call us. Our number is 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back. Guy is on vacation this week, so you have me. Right before the break, we're talking about our philosophy of guaranteeing an income stream that pays at least your hard expenses. The rest can be in stock market, things like that. Make sure you have your reserve account. Remember that reserve cash account. I know it's not making anything in money markets and all that, but that's not the purpose of it. The general rule is 3 to 6 months worth of expenses in reserves, but that can't be the same rule for a 7-year-old as a 30-year-old. So the real rule should be 1 to 2 years worth of cash expenses as you get older and close to retirement. That way you can handle anything. I have 4 children, and there's always something coming up. So you got to have those kind of emergencies. My first one went to college for about 9 years, so I don't know how much the next ones are going. I remember when back in the day when college is like $1,000 a semester, $800 a semester. Books might be $30. Well, if you've had any kids in college lately, it's a little bit more. I've got 3 little ones going to go in the next 10 years or so, and oh my gosh, I figure I worked about 93, and we'll get them all covered. But so you create an income stream to cover your hard expenses. The rest you can have in cash, the stock market, stuff like that. But what do you do when the stock market's gone up almost 9 years in a row? When the PE ratio, the price earnings ratio of the S&P 500 is 24.25, when historically it's been about 14. And historically every time it got out of whack, 1 or 2 things had to happen. The earnings have to increase substantially to make that valuation accurate, or the price has to come down. And unfortunately, the prices come down. Price just comes down most of the time. You can never have too high of a multiple. Remember what that means is, let's say if you were going to buy a company, let's say it was a private company, and if you had a 24-year multiple, in other words, it take you 24 years to get your money back from this thing. Would you buy that company? Yet people throw money at every public company in the world. Some of them have PE ratios of hundreds. So just always keep that in perspective. It is how many years it would take you to get back. I like a PE ratio maybe 3 to 5 if I was going to buy a company, right? But the average historically on publicly traded S&P 500 large cap companies is in the 14 range, and we're say 24 now. And so there is a valuation issue there. And so what do you do with your stock market piece? I think a good idea is a managed account. Here's why. Most managers, most advisors are buy and hold type. And it works out pretty good when the bull market's running. Works out very well. I think you need a tactical asset allocation right now. In other words, it's going to pull me out if this thing starts going bad. I'm not going to have to call my advisor and say, well, if the market went 50% and they just tell me, stay the course, it'll come back. And it did come back. It just took a lot of years. As I get older, I get less and less years, right? I don't want to wait 8 years to get my money back, 6 years to get my money back. So I would like something that does that. Our managed program at Fidelity does exactly that. It's in every sector of the market. There are 10 sectors in the S&P 500. Why we use S&P, by the way, and not Dow Jones and all. Dow Jones is just 30 stocks. It's supposed to be industrial stocks. The S&P encompasses 80% of the value of the U.S. stock market. It encompasses all sectors and industries in the stock market. So that's why the S&P 500 is much more of an accurate measure of the market. I mean, you can argue the Wilshire 5000 even gets better and all that kind of stuff, but S&P 500 would be the number. So there's 10 sectors in the S&P. Well, you can actually combine 2 of the sectors with an ETF, exchange traded fund. Those are low cost. They're kind of like index funds. The difference between an index fund and an ETF is an index fund is very low cost, and I recommend them every day. Nothing wrong with an index fund. But if you go to sell an index fund at 10 o'clock in the morning because some bad news is hitting, it's not going to sell till 3. And that's along with index funds or any mutual fund. It will not sell until 3 o'clock, with the exception of closed-end funds, which very few people have. Now, with an ETF, you put in that call or that internet order at 10, it's going to sell 10:01. And so you protect yourself. It's more liquid than a mutual fund. The cost is very similar to an index fund, so very low cost. When your average mutual fund in America has over a 1% fee, management fee, plus they have turnover cost, how much they buy and sell stocks within the fund, of 0.5% to sometimes over 1% a year on top of the management fee. That's not disclosed in your Morningstar report. It'll just say, when you look at a prospectus, it'll just say there are trading costs. But what happened years ago is people started getting wise to high fees. And so the mutual fund industry started doing things. The variable annuity industry did the same thing. We need to figure out a way to still get our fees, but kind of put them under the rug a little bit. And so they started doing soft cost. In other words, I know that I do a lot of trades because I'm this mutual fund guy, right? But instead of I know you could charge me a penny or nothing. Go ahead and charge me $20 a trade. And we're going to split the profit some way or the other. So that's what they do. That's why turnover costs can be kind of expensive if you have a high turnover mutual fund, which the more active mutual funds are high turnover mutual funds. And you could look at a turnover rate. If it says like 0.79, that means 79% of the portfolio turns over in a given year. And you can add those up. John Bogle from Vanguard said it can increase your fees up to 0.5% for every 100% turnover. And so some funds have like 150% turnover. We got a break coming up, folks. Remember, if you have any questions, don't hesitate to call us at 972-715-2424 or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by 2 of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Guy Allard's on vacation today, so you're getting my boring lecture right today. We're talking about before the break, we're talking about what do you do with the stock market piece when the stock market has ran for so many years and the valuations are so high in comparison to historic norms. And we said one thing to consider might be our managed program at Fidelity. By the way, our managed program is just like any other managed program. They're all completely liquid. If you don't like it after 2 days, you can get rid of it. But what it does is it's in every sector of the market. There are 10 sectors in the S&P 500. Then you got your fixed income and alternative stuff like that. But if any sector goes below its moving average, it's automatically out of that sector. So let's say technology starts dropping. It pulls out of technology. There's no guarantees of anything in the stock market. Don't let anybody tell you otherwise. But at least the program is specifically designed to protect you against losses. But what if the market doesn't go down for a while? I have no idea where the market's going to go. I just know it's overly valued for historic norms. But let's say it goes for another year or two. Well, you're still going to ride that wave. But as soon as it turns, it's going to start pulling out. It's not like other programs that are offered around. Some of them will take you completely out of the market no matter what. Well, let's say utilities are still doing well. A sector of the market that should do well if the market crashes, because I don't care what happens to the stock market, you still got to pay the light bill, still got to have water. And so maybe I want to stick with the utilities. It stays in any sector that is not going down. So you can still participate in gains instead of be putting in a 0.01 money market. You can still participate in future gains, just not the stuff that's real volatile and going down right now. And it automatically takes you out and automatically puts you in. And what it has is it has a different moving average for every sector, because some sectors are more volatile than others. How this works is a more volatile sector is going to have a wider moving average. Instead of a 30-day moving average, maybe it's a 90, a 200-day, 400-day, whatever. But if they are not as volatile, they're going to have a narrower or a closer moving average. Now, how do we do that? Well, we don't do it. I don't think any advisor, this is not be shocking to some of you advisors that listen to my show out there, I don't think advisors, like myself, are equipped to manage money. I know that might be a shock. They need to hire institutional money managers. That's all they do. They don't talk to customers. They don't market. All they do is manage funds. The one I use is out of Boston, and it's got 8 to 10 PhDs, 2 economists, 2 CFAs. CFAs are chartered financial analysts, one of the smartest people on Wall Street. They have all of that with every trade. All I do is split my fees with them. And so every money manager in the world wants to manage money. I'm talking about professional money managers, not the person talking to you at the Wells Fargo or whatever. I'm just picking on them. They're fine. But you have to think of, what is the job of that person? My job most is talking to clients, is getting them to retirement, allocating their assets properly so they never go broke. It's not being an economist, all right? It's not looking at the details of every single stock or every company or every ETF. It has nothing to do with that. But that's who you need managing your money. If you went directly to my institutional money managers, some of them are $20 million minimum to talk to them. Some of them are $400 million minimum to talk to them. But since you have a lot of independent advisors out there that can pull their resources, they say, wait a minute, we can manage your funds for a lot less. Maybe $100,000, $200,000, $300,000. But you handle the clients. And that's what we do. And I think that is what when you have an advisor relationship, when you have an advisor, he basically picks the best professionals for you, helps you, guide you along that route. But actually doing the day-to-day trades, I think they're a poor example, the typical advisor at any firm you can think of. They're a poor excuse for a money manager. They are a financial advisor. They're supposed to raise accounts. They're supposed to get clients. Okay, a money manager is supposed to manage money, and that's it. And so there is a distinction here, and that might be a separation of what you've heard in the past, because everybody goes to any of these banks, and the guy sitting behind he might be in a cube or might have a little office there in the corner. They want to manage all your money and pick all the funds. Now, sometimes they'll pick mutual funds, and mutual funds have management companies that manage the mutual funds, and they might think that suffices. And it may. As far as your management component, it may. The one thing it doesn't do is give you low fees. You might get charged 1% a year, and they put you in retail mutual funds, charge you 1 or 2% a year. So even though it can accomplish a separation of manager and advisor, it doesn't accomplish the one main thing, is you can't pay high fees. If you pay high fees to a money manager, to a variable annuity, or anything else, one side of the table is going to be very happy and smiling all the time. The client never will, because you can never pay high fees. Well, we got a break coming up, folks. So remember, if you have any questions, don't hesitate to call us at 972-715-2424 or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. Before the break, we were talking about our managed program at Fidelity. It manages in ETFs, and they're managed by an institutional money manager. In my opinion, much more equipped to handle money than an advisor trying to manage money, get new clients, appease their boss, all of these kind of things. These managers have one job, and that's to appease the client and the advisors, but they don't have to deal with either one. You want a professional money management company. And if you do it through our investment advisor, you get the legal fiduciary. We have to look at for your interest ahead of anybody else's. Remember, it's in every sector of the market. If any sector starts going down below its moving average, automatically out of that sector. It is specifically designed to protect your money. And that's what I think people need right now. Because going into a 9-year bull run, I'm just giving you an example. The market's never made 9 years in a row up. This could be the first time. It's not there yet, but it's getting close. So historically, jumping in after 9 up years in a row has been extremely dangerous. But I don't know when it's going to turn. And it's hard for me to take profits out of something making so much and get rid of it. But why not put it in the same kind of thing, but have a program that's specifically designed to pull you out if things start getting hairy? Don't hesitate to call us. If you have any questions, we can send you a free information kit. It's 972-715-2424. Again, 972-715-2424, or you can go to ilovemyretirement.com. A question came in. It's come in a couple of times, but I promised I would address it. And since Guy isn't here, I have more time. And so they asked me how I got in this business. And I guess it's a kind of interesting story. I was in the military. I was doing nuclear chemistry on the USS Enterprise. I was on the LPO and Ford in charge of the Ford Group reactors on the USS Enterprise. We were stationed out of Alameda in California. I was kind of an independent sort. My dad actually owned a commodity brokerage firm at the time. He wanted me to work for him, but I was very independent. I said, I'm not taking anything. I have not taken a penny from my parents since I was 13. I've worked full time since I was 13. I was very independent. So I did that. And by the way, he said, I'd have paid for SMU, go to law school, whatever you want. I said, I don't need your money. I went, well, maybe I was a foolish 18-year-old at the time. But I did that, and when I was about to get out, my father asked me, why don't you try this commodity brokerage thing? I said, okay, I'll try it before I go to some nuclear power plant or whatever. Now, they were offering me like $80,000 a year for like Mare Island up in San Francisco, which is a government contractor, or I think Glen Rose was offering me, $80,000 a year back in the 80s was pretty good money. So I said, no, I'll give this a try. So I did this, and after the first month, I remember, we cold called. And for those of you out here that think cold calling's great, it's the worst job in the world. I said, I think I've been told to screw off about 500 times in 2 days. Or people hung up on you a lot. That's all we did. We worked from 8 a.m. to 10 p.m. Monday through Saturday. And I had just turned down a very high-paying job back in the 80s. And I made $100 total. $100 total my first month. And so I was rethinking this whole, I want to be a broker. Back then, they didn't call them financial advisors, just called you a broker. I said, I'm rethinking this broker thing. I overheard my father telling my grandmother, which my grandmother, if you know anything about me, she was my world, my favorite person in the planet. He was telling her, well, the Navy ruined this kid. He can't give away bread in a famine. He needs to go back to that engineering stuff because he surely can't do this. Well, I heard that, overheard it, walking by his office. I didn't say anything to him, but it struck a chord in me, and I said, I've never failed at anything. This is going to kill me. I will not fail here. And he had about 50 brokers in the office, and I became the number one broker. For the next 3 years, there was only 2 months that I didn't win the contest because they had a contest. Who's going to be the top broker out of this 50 brokers office? And like I said, 2 months out of the next 3 years, I didn't win. A couple guys got a couple of lucky deals, But that's how I got in the market. But I found out really quickly, commodities aren't for me. If you've ever day traded or option traded, it's like it's on steroids. The leverage in the stock market is something, an option market. But in the commodity market, holy moly, somebody could send you a $100,000 check. Before that check clears, they owe you $100,000 on top of the 100 they already lost. Well, I'm not much of a gambler. I don't like Las Vegas. I'm not a gambler at all. I said, this isn't for me. My dad called me a wussy and said, don't you know how many times I've turned 100,000 into a million? I said, how many times have you lost 100,000? That's all I cared about. And so I started doing this, and it's become my lifelong mission because I truly believe there's so much bad advice going out there, so much things masquerading as advice. I've tried to expose the people selling those life settlements, all the oil wells and some of the scammy real estate deals out there, because I truly believe I'm helping people. And if I know that I've created a plan that they're never going to run out of money no matter what happens to the stock market or real estate or anything else, then I've done my job, because I'll never have to field a phone call from a decision I made that this market just crashed 50% and my 80-year-old client has to go back to work. I don't want to ever have to do that. I don't want a client to ever have to do that. So this has become a lifelong mission, and I'll never stop. I'm a worker type. I think I've taken off 5 days this year so far. And that's because my wife made me. Well, I got a break coming up. I don't want to bore you anymore with my story, but I got a break coming up. Don't hesitate to call us. If you have any financial questions, would like to take advantage of any free literature, call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Well, I'm the most experienced. He's the oldest. Since Guy's not here, I can do this. We talked a little bit today about what do you do with, you remember our philosophy, have your bills paid by a guaranteed income stream. And you can do it any way you want, with annuity, without annuity. It just takes less money if you do it with an annuity. Okay? Always choose low cost everything. Do not pay high fees on anything. That's why you're going to stay away from your variable annuities and stuff like that. Stock market wasn't designed to pay the bills, even dividend paying stocks, because none of that's guaranteed. Company can eliminate, reduce, do anything they want with dividends. It doesn't affect them, but it'll affect you in your retirement. So have those guaranteed income streams. And then the stock market piece is, there's nothing wrong with having the stock market after that. Make sure you have your liquidity in place. But I think something to think about is our managed program, specifically designed to take you out if the market started going down. And that way you have something that is going to go, if it goes up for another year or 2, 3 years, you're still profiting. But if it ever turns, you have some kind of protection in there. You can't, to me, buy and hold after 8 or 9 years upper is scary. I've been doing this 30 years, and I've seen it happen every single time. So be careful, because we get lulled into complacency. What happens is the market ain't going down 8 or 9 years. You don't think it's going to. You've watched your portfolio go down 30 to 50% twice in the last 17 years. You're watching it again. Think about it. Just have something like this that might keep going up with the markets. I don't know what it's going to turn. I have no idea. But have the protective feature. Have a hedge in. Our number to call for a free information kit on that is 972-715-2424. Or go to ilovemyretirement.com. Last thing I'll talk about my family love letter again. This is so important to me that even though it doesn't make us anything, I don't care. It's important to me. I've seen too many loved ones, and when they pass away, it is a nightmare trying to get all their financial stuff in order. I've seen things with clients. They buried a person, paid all this money, everybody pooled in, and they found out they had a burial policy the whole time. There's all kinds of things like that because people don't know where your things are. A lot of times you die suddenly or you get incapacitated suddenly. Remember I told the story about my brother. He got Lou Gehrig's disease. He there's a paramedic. His wife was a paramedic, and they had one child. We had 4 children from a previous marriage. Closed down bank accounts, didn't realize that there were insurance premiums going to his other 4 children. So if you know anything about Lou Gehrig, it's a horrible disease, and organs start shutting down. And so she was just trying to do the right thing, but didn't realize these other accounts were out there. And so the moral of the story, they didn't get any money when he passed away, which is never good. You got 5 children, all young age in grade school. We had one of the owners of Dillon Gage die of a rare blood disease. It took us 2.5 years to find everything. And so, does your family or somebody you trust, now you could keep it in a locked deal, say, hey, here's the key to my safe or the thing to my safe. If anything happens to me, look for the family love letter. It's going to have a listing of all your accountant, your attorney, your employer information, if you got employee retirement plans, things like that, pensions, financial advisor, your insurance advisors, your home insurance or whatever, mortgage holders. It has your estate planner, estate attorney. It tells you where your investments are and where they're located. A lot of people didn't know that there was a safe deposit box key. They didn't know a safe deposit box existed. But there is a key, and there's stuff in there that's very important. So you have to you can fill this out. There's no cost, no obligation, of course. But you can get this My Family Love Letter. It tells your, also I'll read the first line. Dear loved ones, this is My Family Love Letter. In an attempt to simplify matters for you, I have written this letter to provide you with information that will help you when the time arises. It has a date on there. It also tells you you've loaned money to certain people. They owe us money, the family money or whatever. You can put on there, I'd like to forgive it if I pass away. Okay? Where are stored assets? Things that they might not be aware that they're out there. And like I said, this can be, you get incapacitated. If you pass away suddenly, here's some liabilities that I have. I'm a guarantor on some debt. Maybe you're a co-signer on your daughter's car loan, whatever. This tells you where all the credit cards, your insurance benefits, if you've got a burial policy, if you've got a life insurance policy. Sometimes life insurance stuff goes unpaid because nobody knows it exists. Here's your disability, long-term care insurance, your employment details. Here's what are their documents. Where's your general power of attorney if you have one? Where's your will? Because not only that you have one, when is the date? Where can that document be found at? All of those things are so important. I may receive an inheritance from this. Sometimes you don't know that they have a relative that has left them certain things, but they still might want it to go to the remaining family. And so what about a computer password? I'm telling you, you lose that thing. They just said Malia Obama lost her password and couldn't get her iPhone stuff back, right? And so it's really important to have this documented somewhere with your Social Security number, your Medicare number, all that kind of stuff. And that's what this family love letter puts it all in one thing. It's on top of a will or trust. It puts them all together for you. Don't hesitate to call us and we'll send you your free copy. It's 972-715-2424. Again, 972-715-2424. You can always go to ilovemyretirement.com. I'm Victor McClure. I always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.